Here's some things that you absolutely have to know before you apply for a loan from any lender, whether it be a mortgage, credit card, car loan, anything. This is that important. My name's Ryan Stewman, and I'm the president and CEO of Closer Capital, where we help entrepreneurs like you get access to the money they need so that you can grow and scale your business. One of the things that I see, which is easily avoidable on a daily basis, is when people go and they apply for a loan, oftentimes what happens is they wait till their credit card balances are high and they need money for a loan, obviously, or they haven't taken care of they haven't paid their monthly bill yet. So it's showing that there's a big balance on it. Let me give you an example of what I'm talking about. This month, I had to make a substantial purchase on one of my personal credit cards. 2 days later, after I make this purchase, now it probably used up 40 to 50% of my available credit on that card. I hardly ever use the card. I'll pay it off at the end of the month. My credit score went from 816 to 680. I didn't miss a payment. Nothing changed in my ability to repay loans. I just used that credit card a lot for a large purchase, obviously, one time, and it changed my score 100 and almost 40 points, 135 points. Now, why do I tell you that story about myself? Because I'm in the process right now of getting a home equity line of credit on my house so that I can use it to invest in other stuff and just absolutely have it there in the event that I need it. When I'm on the phone with the loan officer for the bank where I'm getting this home equity line of credit at, I made sure that they understood, like, don't pull my credit right now. Okay, we'll close this loan next month, but don't pull my credit right now because I got to pay this substantial credit card bill off at the end of the month. And if I pay it off now or pay it off at the end of the month, it's not going to affect our deal here. But here's what will happen. If they pull my credit right now, I'll be a 680. And at a 680 credit score, I'm going to have A minus, B plus rates, depending on what I'm applying for a loan for. Meanwhile, as soon as I pay this off and my scores resettle, my score goes back up to 800 plus, 780 plus, whatever it winds up at, then what will happen then is I'll qualify for a top tier rate. So the lesson from this for you is if right now you're carrying credit card debt, before you have a lender, us included, pull your credit, pay off your credit card debt. Let's say that you're coming to Closer Capital and you're looking for a $100,000 working capital or line of credit. And you have a $20,000 limit credit card, which you've got $7,500 to $8,000 on. That's going to be affecting your score by as much as 100 points. It could totally change the interest rate that you get. Instead, what you want to do is pay that off, then come apply. And I'm not trying to tell you to hold off on putting an application with us, but you can make us aware of this. Hey, let me pay this off and my credit rescore before you guys submit this. That's going to put you in the best possible position to borrow money, because here's how creditors here's what they don't tell you and how they get you, right? Oh, you got a 680 credit score. We're going to have to give you a 14% interest rate. Oh, you have a 780 credit score. You get a 9% interest rate, right? So it's almost double what you get with that amount. Again, nothing's changed in my income. Nothing's changed in my ability to repay. I just have a credit card with a balance on it. I see this happen to our customers all the time too. Oftentimes what I'll do is I'll say, hey, the reason you scored this way is because you've got this debt on your credit card. Let's pay it off, rescore this thing, submit it, you'll be able to get the loan. A lot of times lenders, they don't want you to get a better loan. They don't want you to get a lower interest rate because that's less money that they make. But I'm on your side. I'm here to make sure that you qualify for the best situation financially possible for the situation that you're in. The other thing that you have to understand about this is timing. Okay, about last November, I went and bought a car. And at the same time, I had to purchase a mortgage. I was buying a house, and I went and bought a car. Now, my entire adult life, I have either paid cash for cars or put them in a company name. There's not been a car in my name for a decade or so in my personal credit. So I go buy this car, everything, signing up on my business credit. A month later, the damn thing shows up on my credit report, tanks my credit 140 points because I got a $140,000 maxed out installment plan that just shows up on my credit. I had to go sell the car. I'd rather have no car. I didn't need the car. It was an extra anyway, but I'd rather not have the car and had good credit for the situation that I was in rather than have the car. So it took me 60 days to get the damn thing off of my credit and everything reestablished. So I tell you this because you have to be conscious about your credit. Credit is a revolving, moving, evolving thing. One day it could be 800. The next day nothing changes on your end. You just went over a 10% ratio from the amount of credit available to the amount utilized, or maybe you went over a 20% threshold. They go 0 to 9% barely affects you. Maybe a 10, 20 point cost. If you're holding 10% to 25%, you're going to have a significant credit cost because they don't like you to have that much of your credit line utilized, even though they offer it to you. If you go beyond that, then they could tax you as much as 100 points. So a simple solution to that is, because we hear this all the time, it's like, I should have good credit. We'll just pay off these 2 credit cards, we'll re-pull it again, and we'll get you situated here to where you will have a good credit score. Because good credit and a good credit score are literally 2 different things. And in this scenario, according to every lender out there, the score is what matters. So the more that we understand how to get the best score so we get the best bang for our buck when it comes to interest rate, the better. So if you are thinking about getting a loan with anybody, the first thing that you should do is pay all your credit cards down. You don't have to pay one off, but you pay them all down to where they're less than 10%. So if you have a $20,000 credit line, you want to pay that credit card down less than $2,000 balance on there. If you got 3, 4 credit cards and you'll put a little bit here, a little bit there, buy that down, that'll extend your score and raise your score significantly without having to pay for credit repair. And by the way, like if you come to us and you get a loan and you pay, like, let's say $8,000 worth of credit cards off, you get a higher score, we give you a loan, you accept it. Nobody says you can't just go right back and charge those up or put that money back in your bank account from the loan that you're taking. So, being able to move things around and get them situated in your credit to where you're in the best position possible is what we do here at Closer Capital. So if you want to talk about the best scenario for you, you can always go below, click the link, and apply on our website. One of my amazing team members will be more than happy to answer any of your questions. You can also call Linda, our automated AI agent, who can answer all of your questions, take an application from you, run scenarios by her, all of that good stuff. Her phone number is below. We'll see you next week on the video. If you know a builder or a real estate fix and flip investor, send them this video. Tell them to go to closercap.com and connect with me. I can help them make more money and make their life easier. Catch you on the next video.